I'm joined by Cristian Ulloa, the co-founder of Liquid Loans, the borrowing and earning protocol on Base. Cristian just released his new book, Hold, Borrow, Build. It's based on 20 years of experience helping lead some of the world's largest accounting firms. Cristian, I got a couple questions for you, but first off the bat, I just want to talk about and address this whole situation between Jamie Dimon and Brian Armstrong. Jamie Dimon called him, quote unquote, full of shit. What do you think about that? Like, what exactly is going on here between Jamie Dimon and Brian Armstrong?
My initial reaction to that was I'm not surprised, but I actually thought it was quite an aggressive statement to make. And the reality is that people need to sort of look behind why the comment was made. And it's not just purely about just, hey, the stablecoins shouldn't be able to provide interest. Fundamentally, what the concern is that people will exit the traditional banking system. A lot of the current deposits that sits in traditional banking will actually move towards the likes of USDC, and all of a sudden we're going to see capital flight out of the traditional financial system into stablecoins like USDT and USDC. You know, if you take Jamie Dimon's perspective, he's saying, hey, if Coinbase wants to be a bank, then be regulated like a bank. You know, go through all the regulatory requirements that a bank would need. But I would argue that Coinbase isn't trying to be that. And more importantly, Coinbase doesn't have fractional reserves. They're fully backed. That is a major difference. And for me, that represents a far better proposition than a bank that only has fractional reserves. The challenge, however, still is that, hey, despite the fact that you've got the likes of USDC and USDT that are backed, there's always question marks as to, how backed are they? And I think USDT has always had this sort of question mark around, you know, do they really have full reserves? It's kind of perverse, really, because the accounting firm that I used to work for is actually the auditor for USDT and Tether. And so fundamentally it was, you know, not that I was part of any of that, but it was interesting to me that that's always been a question mark, that, hey, is it really fully reserved or fully backed? Are those reserves available? But that I think is a far better proposition than a banking sector that relies on, oh my goodness, people are coming to withdraw their funds, we don't have enough. There's often bank failures that are backstopped by other banks and sometimes the government because of that, right? Because credit is created in such a manner. I think that's the real tension. At the end of the day, the concern is that deposits will move away from traditional banking into stable coins, and that's going to put a lot of pressure on the traditional banking system.
So who's really full of shit then?
I think they're both full of shit. And why? Because one is founded by fractional reserves. The other is purely a centralized play. Who do I trust more? I prefer the centralized model because I know it's fully backed until it isn't, right? And the day that happens, then it just reverts to what we've always had, which is fractional reserves. To me, I want to be my own bank. That's what I'd like to see. And that's why Dave and I developed Liquid Loans, is because we didn't want to trust in a third party, whether that's a stable coin through the likes of Coinbase or relying on fractional reserves in a banking system. We wanted to be the bank, and that's what Liquid Loans allows us to do.
Jamie Dimon also said that, quote unquote, the banks will not accept the current terms of the Clarity Act, most likely, obviously, around the stablecoin yield. That's what the battle has been about between him and Brian Armstrong. But when just looking at this whole entire thing from, you know, your perspective, being on both sides, Cynthia Lemus also just said recently, we covered it today in the Coin Zone, the live stream, Jamie Dimon is saying things that don't really make sense, and he needs to read the bill again. But is there really anything in there that is unfair from Jamie Dimon's perspective, you know, giving crypto the leg up in any way over the banks when it comes to stablecoins?
I think, look, his argument is valid to a point that, hey, you know, why should stablecoins not be caught under the regulatory requirements that traditional banking has to go through? But I would argue that some of those laws are quite loose. And, it has led to the problems that we're having now, which is, again, fractional reserves. So by introducing stablecoins that are fully backed, that's a great step in the right direction. My only concern is it's still centralized. So it's just a power shift. It's moving from traditional finance to stablecoin providers. That's the power shift. Do I agree that this is the best future for us? Well, I think it's a step in the right direction, but I'm not so sure that it's the entire story. And what do I mean by that? I actually think the biggest challenge that we're going to have, even with stablecoins, is just by their very nature that they're centralized. And once you're centralized, things can change over time, and you've effectively lost control. So you do not have control of those funds, really. So things can be turned off, things can be switched off. And fundamentally, that's the concern I have, is that we don't have self-sovereignty over our own funds. And to me, that's what, the reality is liquid loans is very much about avoiding that, if you're looking at creating wealth, you can use your Ethereum to do exactly that. And one way of doing that is to mint your own stablecoin. But that's self-contained, right? Now, will that ever provide enough liquidity to fund the entire system? No, it won't. That's not the intent. The intent is to actually help people create wealth by generating a stablecoin that they can use in the system. But coming back to your question around Jamie Dimon and Brian Armstrong, I just think it's a power struggle. So fundamentally, the Clarity Act will give stablecoins a leg up, no doubt about that. But I think it's the right move, because trying to reduce fractional reserves should be paramount. I think that's probably the biggest issue that we struggled with when things changed in 1970s, that, all of a sudden things are not backed and we've got fiat that's just, you decide every bank basically can create money backed by really nothing. And that's the fundamental concern that I have, is that system has to change.
Now, when it comes to the Clarity Act, we're probably the closest we've ever been to it actually being passed now. And a lot of people have been saying this whole time, it's better to get something passed now than nothing passed at all, even something that might have some bad language in it. But what are your thoughts surrounding that? Just the current Clarity Act, if it was passed right now, is it something that you would be in favor for?
Well, if you're being more specific, what do you feel that isn't ideal in the Clarity Act?
Me personally?
So I'm looking at it thinking, well, if the only issue is around providing interest on stablecoins, if that's the blocker, like I would say, my view in general is that interest should only be paid for something that you're foregoing. So just a transaction account at a bank account should not be paying interest. It shouldn't be paying interest at all, because you're not doing anything. You're not foregoing anything, as opposed to say, hey, you've got a term deposit, or you've locked up funds somewhere using a stablecoin. You've locked them up. You've staked them somewhere. You're actively doing something with your asset, whether it's a stablecoin or whether it's a deposit at a bank. If a traditional, just a standard saving account is paying interest, I would argue, for what? Like, is it just to attract people to deposit and really be able to continue to transact? And they're not foregoing anything. That's my argument would be, hey, don't pay interest on transaction accounts. Pay it for term deposit. If you're locking something up, okay, that's fair and reasonable. You're foregoing something. It's no different to, in general, crypto, where, hey, I don't agree with just holding an asset such as a stable coin and earning interest just for holding it. That to me doesn't make any sense. It makes a lot more sense if I'm locking that stable coin up and I'm generating interest that way, because I'm foregoing something.
Yeah, and we're seeing, platforms like Ethereum and Base also kind of leading the way when it comes to a lot of what we're seeing now in a decentralized market kind of take place when it comes to transactions. AI agents are showing strong use cases on Ethereum and Base right now, and also with RWA and tokenization as well. But what do you think sets, crypto apart right now? Even Jamie Dimon himself talks about tokenization, and Jamie Dimon does use Ethereum with JP Morgan. So how do you see these assets like Ethereum and Base, and L1 with, it's fast, low fees, kind of taking place over the next couple of years ago with these AI agents, and now the Clarity Act being passed as well?
Yeah, I guess I look at this and I think, well, realistically, it's Base is a layer two. It's cheaper, it's faster. Does it have most of the transaction volume? I believe it does. I think outcome is probably, in terms of liquidity, it's probably a little bit larger at the moment. But I'm seeing Base as being, in the future, it will be the predominant layer two that facilitates a lot of these transactions. To your question around, hey, where do we go to from here? I just see a lot more activity on Base. And look, well, where most of the discussion seems to be heading towards AI trading bots. I'm not a huge fan of AI and trusting in AI implicitly. And I couldn't imagine, the last thing I'd ever want to do would be to enable an AI bot to transact on my behalf. Despite the fact that you might say, there's an argument that says, okay, well, driverless cars, for example. Okay, how do you feel about that? Well, the starting transition was, hey, it's driverless, but you can take over. So there's still a steering wheel. You can take over and drive if need be. Then that moves to, okay, well, you're no longer needing to drive it. It will be fully automated. There's always a risk there, and always a concern. For me, that's a big concern. I'm not comfortable in that environment, and maybe over time that just becomes the norm. So it becomes more accepted. But the fact that people are relying purely on AI bots to do transactions, I think whilst that may seem, on the face of it, may seem a good step forward, I'm always pushing back and saying, well, as soon as we start to outsource our own personal judgment, I think we're at massive risk as a society, that all of a sudden things will be taken out of control, and we have no control, and we don't even think about these things. And so it begs the question, well, what's our role in society if it's not to apply judgment to some of these things? And it's interesting because I was watching a YouTube channel. I think it was Diary of a CEO as the content provider, but the founder there was talking about their build. Despite the fact that you're hearing about all these layoffs in AI, he's building a team of AI folk that actually know how to use AI and know how to set up agents and do all of that. And they're recruiting significantly. So it's just a shift away, but I still feel that purely relying on something like AI, to me, is no different to counterparty risk. It's the same sort of thing. At the end of the day, you're trusting in something else to make judgments for you. That, I think, is a fundamental risk. And I'd prefer to push back on that. And maybe it's a gradual thing. Maybe it's the trust levels start to increase and you can let go of some certain things. But the idea of an AI bot doing all of my transacting, I'm just really nervous about that. And I do recall a recent conversation I had with someone from Hanson, where that's exactly what they're doing, that they're facilitating trading using AI bots. And I pushed back on him. I said, listen, I'm the worst guy to be asking about trading because I don't necessarily believe in it. I think I think I said it's a mug's game. It's really quite challenging to be successful. And 9 times out of 10 people will tell you about their successes, but they avoid ever telling you about their losses. So the idea of having an automated system to transact for me, whilst that would take away the emotional element, there'd have to be some safeguards, and maybe it can be successful. And it's early days for that, but I'd be probably the last person to switch over to something like that. And again, I'm not a big believer in trading to begin with. So I'm not necessarily, I don't think these bots will ever outperform in an up market. And the reason I say that is that trading requires you to sell. And there's two issues with the sell side of things. And that is, as soon as you sell, you're putting downward pressure on the asset that you believe in. So that's the first thing. And then the second thing is, if the market isn't on an uptrend, every time you buy back in, you're actually buying back in at a higher price than what you've sold. That gap can amount to a significant amount over a period of time. So even if the bots are doing exactly what's required and they're actually transacting, and they're transacting using certain parameters, I believe you're losing in an up market. So if the market's on the way up, every time you've sold out because the bot's doing what it's meant to be doing, the gap between when you've sold and when you've purchased, again, that gap, you never recover that. That's your loss. And the bots will never recover that either. So I'm not convinced, but, maybe it's because I'm old school, but I also think that just some caution, some trepidation is not a bad thing. Can I be convinced? Yeah, sure. If you demonstrate that there's some real value there, and there's parameters and, can be managed, then that could be a really good thing. But for now, I'd prefer not to be using AI bots for that reason.
Makes sense. Well, if you're not too excited about AI agents and AI and Base at the moment right now, Cristian, what are you, really excited about?
I think, excitement for me is more about watching the shift away from people looking at fractional reserves, looking at, despite the fact that it's counterparty, but it's fully backed stable coins. That move is a good move, I believe. The other thing that I'm noticing on Base in particular is, realistically, there's a lot of organizations now, again, just a recent conference in Vietnam, where there's a lot of emphasis around real world assets. And my view, and again, I tend to challenge, because we get approached to assess some of these organizations, really understand how that plays out. And there's a number of fairly significant projects that we're sort of talking to help them. But the real question comes down to, well, why do you want to tokenize? Like, what is it exactly that you're trying to achieve? And I think I'd argue that a fair amount of those discussions are about how can we raise capital using a tokenization approach for real world assets. So we're looking to build a particular project, whether that's an infrastructure play, whether it's a particular property development. Fundamentally, tokenization becomes part of the narrative around, hey, this is just another mechanism for us to raise funds. And whilst that's a good thing, I've seen that play out quite well within the property sector, particularly in Dubai. I just think there has to be some caution, because there's another issue that will start to surface as people move into this space, which we've only realized quite recently, is that some of these assets, for example, if there's an electricity grid, there's an infrastructure development that needs to be funded through tokenization. But part of the return has to be, well, what's the return that we're getting from this grid? How do we know that the grid is actually working optimally? What are the returns? Is there excess capacity, under capacity? All of these kind of metrics get measured at the location, but they don't necessarily translate easily onto the blockchain. And if they do, the reality is you're trusting in someone to transfer or to basically provide that information to the blockchain. So whilst the likes of Chainlink, for example, are very good at ingesting some of that information, they use multiple nodes to do that and they aggregate the data. The reliance is ultimately on, well, how do we know that original set of data is correct? And so we're seeing that what will happen with a lot of these projects that are heading in this direction will be, they'll either have to accept that this information is correct, and that can then lead to a whole bunch of fraudulent, inappropriate behavior, or you look at oracles that can actually provide a way of a consensus mechanism that can actually validate the information at source. Now, let me give an example. Again, an energy provider, they have a whole bunch of metrics that they produce at the local level. Now, it would behoove an auditor to say, hey, why don't we run a series of reporters or basically providers of information that we can actually gain some consensus on a more regular basis. So there's a mechanism that captures that information, aggregates it, ensures that the information is solid, and there's always someone that's going to pay a penalty if the information isn't correct. So that can be done by the auditor, it can also be done by the client, and it can be done on a fairly regular basis. And the reason I mention that is because we built an Oracle service around that particular methodology called Fetch. And we did it because we needed it for liquid loans. But we've also realized, hey, this is a consensus mechanism that can be used to validate the outputs that come from real world asset classes that are not easily translatable onto the blockchain. So there's a mechanism there, and I think that's what you'll see the evolution of that. And I have seen some discussion on this topic, but I think it's downstream. So all the energy at the moment is very much on real world assets. So to come back to your question, why Base? Because I think most of the attention's happening in Base. And I've heard, I think just today or yesterday, there's discussions that Coinbase is having with the likes of Stripes, MasterCard, etc., to help facilitate transactions on the blockchain for credit providers of that nature. So again, there's a lot of activity, there's a lot of emphasis on using the blockchain. I think Base is very well positioned for that.
Yeah, and just staying on Base for a little bit too, and back to Brian Armstrong, how important do you think it is having Brian Armstrong and the distribution arm of Coinbase as well behind the project that just brings so much attention in regards to building a community and attracting developers and, et cetera?
Look, I think it's always good to have a visible leader when it comes to a blockchain. And because ultimately that's where credibility starts. So people need to understand, well, who's behind all of this? So it's having Brian Armstrong at the helm and engaging in these sort of discussions, despite the fact that he's copped a bit of a spray from Jamie Dimon. I think that's crucial. So for me, that also adds a lot of weight to what's happening on Coinbase. Now, is it perfect? No, it's not. It's not perfect. And I'd argue that perfect is a spectrum anyway, right? So, but it's heading in the right direction. For me, the biggest shift is shift of control away from fractional reserve to something that's fully backed. That's a good move. Having projects, real world asset introduced to a blockchain, something like the layer 2 of Coinbase is very good. So having that available is also going to see a lot more projects coming on board and using the blockchain for that reason. The only other issue I think that we're going to have to deal with is just all the regulatory stuff that seems to float around tokenization, right? So just ensuring that, it doesn't, regulators need to partner with developers on this front rather than corralling and actually stymieing innovation. They should be partnering. And I think there are certain jurisdictions that develop what they call sandboxes, which basically means, hey, if you have a project, we haven't figured out all the regulatory requirements just yet, but come and play in this safe environment so that, hey, if we need to make changes, we can, but you're not going to be penalized because you've taken a particular path that perhaps we'd like to monitor a bit more. So I think jurisdictions that take that approach are more likely to succeed than those that don't. And I've seen a shift, and obviously we've seen a shift in the way that the SEC has been regulating. And I think, again, there's a bit of a power struggle as to who's going to be the regulator in that environment. But that to me is quite crucial as well, right? So the regulators aren't the blockage. They're there to support and they're there to sort of monitor, but not necessarily to stymie innovation. And I think we're going to see a lot more of that coming through layer 2s like Base.
Yeah, I think Paul Atkins at the SEC has done a great job, and we're finally getting some clarity and distinction between the SEC's role and the CFTC's role. And I think with the Clarity Act here, would you say at this point finally that Trump is, putting America first and he's going to make America the crypto capital of the world and this whole spiel if the Clarity Act passes, or do you think it doesn't really matter? Crypto is this global asset.
Yeah, look, We're getting into geopolitics, which it's a bit of an interest for me because I think everything seems to run from that. And I actually heard some commentary from someone I like to follow called Tom Luongo. Tom made a comment this morning and he said, look, don't be surprised to see a lot more pressure on the likes of Bitcoin as a result of Treasury wanting to acquire more of it. So potentially something's going to break. So one of these ETFs, and we all know who the biggest player is in this space. There's been a lot of commentary around sell-off of Bitcoin. I'm expecting a little bit more downward pressure as a result of that. But that's purely, I believe, what's going to end up happening is that Treasury just wants to acquire more Bitcoin. And I think a sovereign wealth fund that includes gold, silver, and Bitcoin is fantastic. So what has to happen to really balance the books? Because a lot of people tend to focus on, okay, let me take a step back. What is a balance sheet? There's the assets and then there's liabilities. A lot of the focus seems to be about all the liabilities that the balance sheet has. But they don't ever focus on, well, what are the assets that you're building up? And I look at it and I think, well, let's face it, the US has a significant gold reserve, but the pricing of that gold is really low, as in how they're measuring that asset on the balance sheet. And conversely, if they're building up their asset base of Bitcoin and the likes, it only takes for those assets to balloon in value, then all of a sudden, basically the liability side of the balance sheet, whilst it's not ideal, hey, you've got to also look at the asset side. So if the asset values are starting to increase, the net effect of that is your net position is not as bad as you might have thought. So I actually think what's happening is that there's a lot of assets being acquired by the US to balance the balance sheet. So despite the fact that there's significant credit out there, building up the asset base and potentially revaluing some of these assets could be the end game. And that ends up helping to square off the significant amount of credit that's out there. So what does that mean for the likes of Bitcoin? I think in the short term, there's going to be a lot of downward pressure on Bitcoin. But I also think long term, my goodness, it will basically start to be revalued over time, as will gold, as will silver, if they're part of the sovereign wealth fund. And I think that's the direction that Trump is taking, is to how do we build the asset base? As much as we've got all these issues in the credit side of things and the liability side of things, how do we build the asset base up so that America can start to unravel some of the years of problems that started way back in 1970?
Yeah, and when talking about Bitcoin, we've seen it kind of decouple from the rest of the assets that have been performing really well over the past 12 months or so. It's leaving a lot of people kind of scratching their head or curious about Bitcoin when, if you zoom out, in reality, it's kind of doing what it's always done, basically, in its 4-year times. But how do you see the crypto landscape right now and into the next, 12 to 24 months? Do you think we're kind of overdue for some massive leg up, some massive bull run, et cetera? What do you think is going on with crypto at the moment?
Yeah, I look, my honest opinion is that we're probably going to see a bit more downward pressure on Bitcoin. We know that it tends to lead the rest of the crypto market. So the reality is that everything else will follow that. So if we're following and tracking Bitcoin, it is very much, there is that relationship between the other assets. So what do I really think? I think at the moment, there's going to be some pressure applied on Bitcoin. I wouldn't be surprised to see it dipping under the $60,000 mark. As disappointing as that may feel, I actually think that's just in order for potentially Treasury to acquire and others to acquire cheaper Bitcoin and add to their sovereign wealth funds. When that stops, and who knows when that may happen, I think we'll start to see the leg up. Everyone hopes for a bull run. The reality is we're now playing in a geopolitical space. This is not retail now. This is the major players looking at how do we build up our sovereign wealth funds? What are the assets that we need to add to those funds? If Bitcoin is part of that, and I suspect it is for a lot, then how do we acquire more of it? And are we seeing sort of down legs at the moment purely to enable that? And I think there's a real potential for that to happen. And so, look, that's what I'm seeing. I'm hopeful that it turns. I don't think this is any downtrend. I don't think it's permanent. It will certainly come back, and it'll come back quite strongly. So personally, what am I doing? I'm acquiring more Bitcoin because I actually think it will come back. But having said that, I'm also acquiring a hell of a lot more Ethereum because I do believe that Ethereum will outpace Bitcoin in the long run. But that's just me.
Do you foresee, more institutions or countries, et cetera, having Ethereum and as a sovereign wealth fund or some sort of treasury option or et cetera, just to put on their balance sheets? Do you think that's going to happen with other assets like Ethereum outside of Bitcoin?
Yeah, there's a lot of analogies here that you could take. I think a lot of countries, for example, hold gold as well as silver, but they're not the same, right? So gold's utility is, I believe, is just a store of value largely. Sure, you could argue that it can get used, but the reality is silver is, I believe, is more of a commodity, right? It gets used in a lot of different manufacturing processes, but nevertheless, it's still held by, reserves are actually kept by different sovereigns on that basis. So different characteristics, but they're both there. Now, can you apply the same logic to, say, Bitcoin and Ethereum? Well, yes, you can. And obviously, Bitcoin is very pronounced at the moment. Do I see Ethereum making a part or adding value to that sovereign wealth fund that may be created? Yes, I do. Will it happen straight away? I'm not so sure. But nevertheless, Ethereum has a big part to play going forward in that most of the transactions that exist on chain right now, and particularly for stable coins, actually transact on Base and Ethereum in general. So I actually think we're going to see a lot more of that. But whether it actually makes the balance sheet, the asset side of the balance sheet for sovereign wealth funds, I'm not sure. I'd like to think it can, but I'm not sure that it will.
Well, Cristian, you've been in the game for a long time, in the traditional markets and in the crypto markets as well. You've seen a lot of different things, and the current landscape in crypto, it's a little negative. The prices are down, ETH is below 2K again. But what advice would you give, anybody in crypto at the moment?
Yeah, I think the main thing would be take a long-term view. So I can recall when I first started out in crypto, the reality is I came in with the trader's mindset or the get-rich-quick mindset. And really what that does is it drives certain behavior. And it's emotionally draining because every time the market dips and drops, you're constantly concerned about, oh my goodness, I've lost money, blah, blah, blah. If you just zoom out and take a longer term view, you start to see that those dips and the troughs that occur, they start to smooth out over time. If you take a longer term view, you're less emotional about what happens with the market. And so for me, despite the fact that, hey, I do hold Bitcoin, and the price isn't exactly where I'd like it to be, I'm nowhere near as concerned as I used to be in the past because I have a different mindset. The mindset is longer term. Longer term, this is a good thing. I believe in the asset and I believe it will appreciate in price over time. So don't be concerned about the immediacy of transactions or the immediacy of prices going down because you're taking a longer term view. And I think the benefit of that is it just takes away all that emotional drain that occurs when you're seeing the price charts dip significantly. It just, you're not concerned because you believe in the asset base itself. So I think that's my counsel to someone just coming in. Don't think short term. Don't come in with the trader's mentality. This is not a get rich quick play. This is a build wealth over time play. How do you do that? Well, you actually have to have the conviction of the assets that you believe in and acquire them over time. And don't be so concerned about when the market is on a down run or, there's a trough and don't worry about it. Just believe in the asset and keep acquiring and take the opportunity that when there is a downtrend like the ones that we're seeing, for example, in Bitcoin and Ethereum, acquire more. If you believe in the assets, acquire more of those assets. Again, not financial advice, but this has just been what I've learned over my time in crypto.
And if you really believe in the asset, then don't sell it and use liquid loans at a 0% rate to take out a loan against it, and learn more about that and a lot more with Hold, Borrow, Build by Cristian Ulloa. Cristian, where can we get that book, by the way?
Look, the reality is, it's on Amazon, so you can actually go on. It's on Kindle, so you can download it there. For me, it's just a representation of my experience in crypto. It also does talk about, well, how do you build wealth in crypto? And it touches on those issues of holding the asset that you actually believe in, borrowing against it, and why? Because a little bit of leverage to add to a position actually accelerates growth. But my only concern for people is, and I've seen this, people just go nuts and they just borrow far too much. They over leverage, and all of a sudden, there's a downturn in the market and they're in a really difficult position. So my attitude is leverage is good, but just be conservative. Why do you want to leverage? Well, you certainly want to leverage to accelerate growth. It's no different to, I tell you the classic example, when I explain this, people get it straight away. It's like the property developer. Everyone knows someone that has a property portfolio. Well, most of us do. And what tends to happen there is that they start off with one property. Great, fantastic. They allow that property to appreciate in value, and then they borrow against the equity in that property to acquire the next one, and then so on and so forth. And that's how they build their property portfolio. The ones that tend to fail, even in property, are the ones that excessively leverage. The ones that are more successful are more targeted. They still use leverage, but they're building a portfolio. Crypto is no different. So if you apply that principle to Ethereum, and you effectively are buying more Ethereum, but not over leveraging, if you believe that Ethereum will go up in value over time, that's a fantastic way of accelerating wealth creation. So what is liquid loans really about? It's about building wealth in a conservative way and using this tool. So when we talk about borrowing, what we're really saying is, guys, if you want to build wealth, leverage against your position and acquire more of the same asset. So acquire more Ethereum and build on your position. The fact that you can do that through liquid loans is a fantastic outcome because you're borrowing or you're leveraging at 0% interest. That's unheard of as a property developer. They'd love to have something like liquid loans. So that's the principle is the same. The only caution that I would say to people is, look, don't overextend. Don't go crazy with leverage, but just build on your position. So that's the whole concept. You hold, you borrow conservatively, and you build on your position. That's how you create longer term wealth, particularly within crypto or any asset class for that matter, is taking that same approach. The other thing that people miss or they don't quite catch is there's two other benefits that come with that. Well, actually a number of them, but one of them is because you're not selling your asset, you're not putting downward pressure on the asset that you believe in, and you're not watching it, go off without you because you've sold out of your position. So that's the first thing. The second thing, for a lot of jurisdictions, whenever you sell an asset, it crystallizes a taxable event. So you've got a tax implication to that as well. So again, that's not how the wealthy build wealth. They build wealth by acquiring assets that appreciate in value, and they never ever sell them. So apply the same logic here. That's how you're going to build wealth in crypto. And I honestly believe that liquid loans with Ethereum is going to be a very good vehicle for people that have Ethereum that want to continue to build that wealth.
Yeah, and Liquid Loans is now on Base. They are on Base and Pulse Chain, and they are the ones who power this video. So make sure to check out liquidloans.io. But Cristian Ulloa, thank you for joining the Coin Zone today. I appreciate you for coming on.